All right, well, thanks for joining us. We'll go ahead and begin. Thanks for joining our quarterly Themes of the New Economy webinar. And today we're talking about the theme home ownership. My name is Sean Morgan. I'm the manager of investment marketing here at Eventide, and I'm joined by Faina Rosenthal, who's one of our research analysts here. So Faina, she has an MBA with certificates in finance and sustainability from MIT. And while she was at MIT, she actually worked at Goldman Sachs and the MIT Office of Sustainability. And prior to MIT, she managed social due diligence at Root Capital, which is an agricultural impact investor. And she has a BA and MA from Boston University. She's well credentialed and she covers all of our everything housing for us at Eventide, along with some other folks. But she has a very unique perspective into the entire ecosystem of housing and home ownership. So everything from home builders to financial institutions. Faina covers all of those. So I think you'll find her insights on today's presentation very helpful and somewhat novel, perhaps, to what you've heard before. So before we begin, I want to explain to you what we mean when we say themes of the new economy and how they provide the framework for investing with a purpose. So we're in this constant transition from the old economy, the way we used to do things, to the new economy, the way things that will be done in the future. And this transition is perpetuated by our innate desire to develop, sustain, and restore our natural resources to meet our ongoing needs. So as society develops, as we grow as a society, and as there becomes more of us, we have more of a need to develop, sustain, and restore everything that we already have to go on and meet the needs of future generations. So within these different ways, the develop, sustain, and restore, we have identified broad secular themes in the economy that are transitioning us from this old to new economy. And within those broad secular themes, we identify what we call themes of human flourishing, that we believe that some themes are uniquely positioned to actually help us thrive in the future. And so you'll see oftentimes here at Eventide, we talk about these themes and how they're powerful drivers of economic growth, but also powerful contributors to human flourishing. So now I want to make a seamless transition, as most do, to talk about a French sociologist from the 1800s. This is Tocqueville. He wrote a book called Democracy in America. So Tocqueville, if you don't know, he's like I said, a French sociologist. He actually came to America in the 1830s to study our prison system, but he ended up just studying American culture more broadly and making some interesting notations. And this is actually a quote from the book that I found very intriguing. He said, "Americans of all ages, all conditions, and all minds are constantly joining together in groups. Wherever there's a new undertaking, at the head of which you would expect to see in France the government, or in England some kind of great lord, in the United States you're sure to find an association. In America, I came across types of associations which I confess I had no idea existed. And this is very interesting. Listen to this. And I frequently admired the boundless skill of Americans in setting large numbers of people a common goal and inducing them to strive toward that goal voluntarily." There was something unique that Tocqueville noticed whenever he traveled over here to America, to say Americans had this ability to identify a problem or identify a goal and motivate each other to go off and achieve that goal. So I often think about that in terms of us as investors, how we can gather together, identify a goal, and go off and seek to try to accomplish this goal together. So today we're going to talk about home ownership. This is a theme that we're very passionate about at Eventide, and we'll break this down kind of into three different sections. So first, why is home ownership good in the first place? Why is this a powerful theme that we believe promotes human flourishing? And then second, we'll examine some of the barriers that we're identifying in home ownership trends. So if we believe that access to home ownership is good for society as a whole, up and down this socioeconomic spectrum, we should identify if and where disparities exist for certain groups of people. And then third, we'll look under the hood and see where businesses and investors can step in voluntarily to build a more resilient and robust economy by addressing some of these problems that the data reveals to us. So with that, I'm going to pass it on to Faina, and she's going to walk us through these sections and show us some data. Thanks, Faina.
Great, and I'll go ahead and share my screen.
Yeah, and I'll stop sharing mine so you can take over. There you go.
All right, let me just make sure that you can see. Can you see my screen, Sean?
That's perfect.
Okay, excellent. So first of all, thank you so much, Sean, for having me on the call. I really appreciate this opportunity to be with you and everyone else on the call today. And just moving on to the first section here, there are many social benefits of home ownership for folks. The first one that comes to mind is childhood stability. Children can benefit from staying in the same school system, for example, as they develop and grow. They have a solid home base during their formative years. That's very positive. There's also community stability. Homeowners tend to stay in their homes longer than renters. The National Association of Realtors estimates that homeowners tend to stay in their homes for a median of 13 years. Compared to renters staying in their homes for a couple of years, 2 to 3 on average. Another benefit is reported lower crime rates. There are reports that point to states with higher home ownership having lower crime rates and vice versa. Now, there are many factors at play, and correlation doesn't necessarily equal causation, but there appears to be a link. And I would also point to civic engagement. People who are more rooted in their communities, really committed to the place where they live, are more likely to participate in local elections and civic groups. I've seen this in friends who have bought homes during COVID and already gotten involved in their local communities, which is great to see. And I don't know, Sean, would you like to add anything else there?
Yeah, this is so interesting to me whenever you look at the social benefits of home ownership. And our point here is not to say that home ownership is a necessity for everyone, that everyone has to be a homeowner in order to be successful or flourish, but having access to some of those things actually promotes a stable community. And if we're looking at making macro changes and some of these large countrywide initiatives to build more resilient communities, a lot of that starts on the micro level. So looking at how do you engage with these small communities? How do you build these more sustainable, more cohesive, smaller communities? And there are a lot of ties between homeowners and the cohesive ties that these small community have that build resiliency.
That's so well said. That's great. Thank you for that. Now, turning to economic benefits of home ownership, first and foremost, home ownership provides a shelter. It's an essential need, and it's really not something to be taken for granted. And it's an opportunity to create wealth and build wealth for your family and for future generations. It's one of the key ways that Americans build wealth. And of course, there are other benefits like tax benefits as well, deductions on interest and even principal payments. But these are just some of the economic benefits of home ownership. Sean, would you like to just elaborate a bit more on that?
Yeah, no, if you'll go to the next slide. So this is all intuitive for us, but if you think about the basic ways, the most basic ways that home ownership can help build wealth. Let's say you buy a house for $500,000 and you take out a mortgage for $400,000. So over many years of making mortgage payments, let's say you pay your mortgage down to $200,000, and that's all you have left on your mortgage, and you're because you're paying down principal as well instead of just paying rent. So meanwhile, let's say your house increases in value to $1 million. And this scenario actually is not too uncommon in today's housing market. So you would have increased your net worth by 8 times over the course of this time, just by choosing to own your home as opposed to paying rent. So if you look at this happening across broad swaths of people, you can see how people have generated wealth by owning their homes. This is just so basic. Now, obviously, there is risk involved in this. So your home could decrease in value, even to the point where it's worth less than what you owe on it. And so this is what happened during the financial crisis. But we actually have data that I'll let Fangina show that shows the likelihood of this and maybe some of the broader trends around who kind of comes out on top, if it's more of a risk or more of a reward type situation for homeowners.
Yeah, thanks, Sean. So just looking at this graph here, broadly speaking, the mortgage debt to home equity trends have favored homeowners over time. And recent data is showing that, it's even more the case in the past couple of years. So if you notice the black flat line, that represents the mortgage debt line, which has been declining and then more or less steady since about 2010, over the last 10 years. And then if you compare that to the escalating home equity line in yellow, obviously that favors homeowners and shows us that, over time, home equity tends to go up. I would contrast this, though, to the years preceding the financial crisis, when the two were escalating in tandem, and then you see, this period immediately after the great financial crisis where mortgage debt overtakes home equity and home equity falls. But, over the last 10 years, the trend that we're seeing is favoring homeowners. So home equity, as Sean, you were saying, is a powerful way to build wealth. It's not the only way, but it is a powerful way to build wealth because of its practicality. So shelter is an essential need. Inevitably, you have to have shelter, whether you own your home or you rent your home. But unlike other essential needs that are consumable, a house is something you can eventually own and no longer need to actively purchase more of. So this is why home ownership is even more advantageous for those who have lower incomes. There's even more of an opportunity to increase your net worth. And it makes sense that a higher percentage of monthly income goes toward essential needs for those who have less income, leaving less discretionary income to invest in the future. But housing represents a unique opportunity to build equity in an asset that appreciates in value over time, and while meeting this essential need. Now, studies showed that the lower the income of a home owning household, the greater the share of its wealth comes from home ownership, which makes sense and brings me to the next part of the presentation. So here we're going to look at some data that we believe marks the opportunity for values-based investors to strive toward a common goal. And Sean, I'll pass it on to you to elaborate.
So we know that overall societal stability is important to all of us. And there's consequences to all of us when there are groups of our society that are not flourishing. So it's an overall benefit to each of us to ensure that everyone has access to the tools that can help them to succeed. And as financial advisors, you know this. So you're always helping your clients develop habits and use tools to help them flourish in the long run. So what our data shows us is that one of the most powerful and practical wealth building tools is not accessible to many of the people that need it most, the lowest income groups. So the maroon line on this graph that was published in a report by the Federal Reserve shows us that only 49.1% of households in the bottom half of income earners owned their homes in 2019. And if you compare that with the 93.6% of those in the top 10% of income earners, you see that there are some of the people that need this most are not taking advantage of it. So this disparity exists for a number of reasons. And take a look at this next chart for one example. Now I'll let Faina explain it.
Okay, great. Thank you, Sean. So if you think about it, if you have to spend the majority of your income on rent, you don't have enough money left over to save for a down payment on a house, which would eventually be your ticket out of paying rent. So, there's a cycle here. And I'd like to break down this chart a bit more. So first, a few definitions. You see at the bottom, severely burdened and moderately burdened. So severely burdened here means that households are spending at least half of their income on housing. And moderately burdened households pay 31 to 50% of their income on housing. So you can see on the left-hand side that households making less than $25,000 a year tend to be severely burdened, and actually the burden has increased over time. And just, it's worth kind of breaking this down in layman's terms, that if you make $25,000 a year and half of your income goes to rent, that's approximately $12,000, maybe even less after tax, or about $1,000 a month to live off of for everything else. And there are people raising a family on that and trying to advance in their lives on that. And then going further to the right, households making 25 to 50,000 a year tend to be moderately burdened. And they have also become more burdened over time over the last 20 years. So turning to age demographics, it makes sense that older demographic groups tend to own their homes at a higher rate than younger groups, as well as that a higher percent of their net worth is tied up in their home as they pay down their mortgage over time and their home appreciates in value. But more perplexing is the disparities that we see across racial groups. And if we look at this chart, we can actually see that for every age group, home ownership rates are higher for white families, followed by Asian families, and then Hispanic and Black families. Now, this graph obviously shows correlation, but as I've said in other parts of this presentation, not necessarily the cause of the disparities across racial groups. And I'll just note that there are many potential explanations for these gaps, and they're likely interconnected. So research by the Federal Reserve shows that there's actually a persistent historical wealth gap across racial groups. The typical white family in the US has 8 times the wealth of a typical Black family and 5 times that of a typical Hispanic family. And as we've talked about, home ownership is a key way that families build wealth. So there's a reinforcing feedback loop between home ownership and wealth. And wealth disparities can also make it harder for a lower net worth family maybe to help their kids out with a down payment on a starter home that could start them on this virtuous cycle. And there have also been historical disparities in home values and how homes are valued among homeowners by race and ethnicity. There's a lot to unpack and to learn and to understand, but as investors, this is something that we should be conscious of as we try to identify, what are the potential barriers to home ownership today if we think that it's good to promote access to home ownership. And we think that it's a good thing. So as you have probably observed yourselves, either reading the news or maybe trying to buy a home yourselves in this past year, demand for home ownership is on the rise. And it's really no surprise if you look at the confluence of these different drivers. Excuse me. So there are over 72 million millennials in the US, and many are entering into the prime age for household formation as they think about starting families, for example, and moving away from their family homes. And they're also being closely followed by the Gen Z generation. And I'll just quickly note that for the millennial generation, which came of age during the great financial crisis, that was a difficult period. Unemployment was high. It took some years for unemployment to come back down. And many millennials were living with their parents, perhaps longer than they had planned. So there was a bit of a delay in millennials forming household in the aftermath of the great financial crisis. And there's a bit of a catch up here. And Sean, I don't know if you want to add to anything to that before I move on.
This is very interesting. And if you've been in the industry for a while, you remember the trend probably 10 years ago. You had REITs knocking on your door saying, hey, multifamily is a huge opportunity right now. Given the demographics and trends of millennials, 10 years ago, they were entering into the rental market for the first time. They were saying they were delaying buying their home purchases. And that was actually driving demand for these multifamily rents. So that was 10 years ago. And you think of the progression of that to where actually that huge bubble that was driving up rents in multifamily 10 years ago is now existing for homeowners. Like that same group is now buying homes. So it's interesting just following the trends, if you've been in the industry for a while, of where we were 10 years ago and then what we're entering into now.
Interesting. Yeah, that's a great point. And then, just moving on to these other drivers, the baby boomer generation, also about 70 million Americans, are actually aging in place and staying in their homes longer. And there also some are competing with first-time homebuyers for entry-level homes if and when they choose to downsize, which makes total sense. It just puts more pressure on housing inventory. And we're also seeing people moving from dense urban areas into the suburbs, a phenomenon some call deurbanization. And more people are also migrating to the Sun Belt, which has seen an uptick in job and population growth over the last couple of years. And COVID really accelerated both of those trends, as we saw last year. And I would also just note the need for replacement of existing housing stock, the normal slack that you would expect with vacancies, and a growing desire for second homes. So these are just a few of the drivers that are coming together at this time in the demand for home ownership. Now, if we take a look at the supply side, let's take a look at home inventory levels. So as more people want to buy homes, there are less to go around. And this graph shows month supply. Now, month supply just means the number of months it would take for the current inventory of homes on the market to sell at the current sales pace. And if you talk to a realtor, and just by looking at this light blue line, they'll say that about 6 months supply is average or normal for modest to see modest price appreciation and just kind of what you see in an average year. And right now we're sitting at around 2 months supply. This is a drastic drop, and we haven't seen these levels in at least a few decades, or at least as far back as this graph goes. Now, new home supply is rebounding, but slowly since the great financial crisis, and not keeping pace with demand. So just looking at this graph, I want to point out, what it looks like pre and post GFC. And leading up to the great financial crisis, you saw the, 5, 6, 7 years of new homes being started, and ultimately leading to an oversupply versus the demand in the market at the time. And you have this crash coming into the great financial crisis. And since then, home builders have steadily been rebuilding supply, but they've been more cautious, more disciplined about the land that they put on their balance sheet, the pace at which they start building new homes. And this pace has not kept up with the acceleration of demand over the same time period. So more supply is still needed to meet the demand that we're seeing now and that we will see over the next several years. So one more thing of note, low mortgage rates recently have definitely improved affordability of homes for those who can afford a down payment, which is another barrier to access. And it's worth noting that the 30-year mortgage rate tracks very closely with the 10-year treasury rate. And you might notice the wider than normal gap between the two last year in 2020. And just to unpack a bit, what I think we're seeing here is mortgage rates didn't drop as much as the 10-year because there was elevated demand for mortgages, and especially to refinance existing mortgages. If you think about mortgage originations, it's either to refinance a mortgage or to take out a new mortgage to buy a house. So this put a strain on the capacity of mortgage originators, and that allowed them to keep their margins higher last year, though they could likely be squeezed in the future as capacity normalizes, which it is. And this could also mean that if the 10-year continues to rise, mortgage rates likely won't go up as fast or as much, at least immediately, because they didn't go down as much as the 10-year in the first place. And we're starting to see that play out, but that's just worth noting what that blip is on that graph. And I always find it interesting to compare multiple converging factors in understanding this question of affordability, because the dark line that you see on this graph shows median home sales price over time, and that has gone up, and it's, you know, as we would expect with the home equity graph that we saw earlier. Now, if you compare that with the median household income, that has also been, you know, modestly increasing over time. But then the mortgage interest rate in orange, you see, has significantly declined, and we're close to record lows. So that brings us to the blue line, which is monthly homeowner costs. And you can see that they're actually still below what they were in the years immediately preceding the financial crisis, and have stayed quite reasonable. So this is a positive from an affordability standpoint. Another interesting anecdote is that lending standards have actually tightened over time. So this can be a double-edged sword. From an investor perspective, tighter lending standards are generally a good thing for companies like banks, like agencies that are exposed to credit risk. But it could also make it harder for low to middle income families that may not have as high of a FICO score as, you know, as other maybe higher income families, to access the financing that they need to buy a home, even if they can afford to make the monthly mortgage payments. So we have to think about it from both sides.
Yeah, so now that we've looked at some of the data, I believe we can rally around a goal to kind of tie us back to where we began, to rally around a goal voluntarily that we agree is good. So since we believe that there's a long-term benefit for individuals, which also leads to a long-term benefits for society as a whole, let's have a goal of responsibly increasing access to homeownership for those experiencing barriers to it. Let's do it in a way that's sustainable rather than just trying to flip a switch and achieve a desired outcome. And we believe actually one of the best ways to do this is by investing in businesses that are addressing the true underlying issues. So what we'll do with the rest of this presentation is we'll take a look at some of these types of businesses and how they're contributing to this overall ecosystem of home ownership and increasing access.
Yeah, thanks, Sean. So there are many ways that businesses are addressing these issues. And I just want to spend a few minutes talking about 5 types of businesses that we've identified, businesses or organizations that we've identified. And I'd like to just explain a bit about each and the role that they play in supporting the home ownership ecosystem. So first, publicly traded home builders, home building companies. These are home construction companies that are bringing affordable new homes to the market that are geared toward first-time home buyers. And there are builders that build to, you know, every type of buyer and every stage in life. But lately, over the last couple of years, we've seen a growing number of home builders really gearing their products toward entry-level first-time buyers, and also to serve you know, folks further along who are looking to downsize. Manufactured housing REITs are interesting. They develop and manage affordable manufactured home communities. And they also sometimes sell manufactured homes within those communities, in addition to leasing the land on which people can put or build their homes. And these are geared toward folks of all different ages and backgrounds, but some are specifically tailored to those who are retired or looking to retire and maybe looking to downsize and to enjoy an affordable, comfortable lifestyle in their retirement. Then there are home improvement companies, and these companies help homeowners maintain their homes, manage, care for their homes, make it a space that they feel proud of and happy to be in. And that's, a wonderful thing in of itself. And it also helps to increase the value of their homes over time as they, are looking to sell or to move. Then there are also financial institutions like banks and government-sponsored entities like Fannie Mae and Freddie Mac. And what they do is they help would-be homeowners get a mortgage. And the GSEs also provide liquidity to the mortgage market. So when a bank makes a number of mortgage loans, then Fannie Mae will buy those loans, securitize them, and sell them to investors, and that will give banks more cash to be able to make more loans. So that's an important liquidity cycle in there. And then finally, I would just point to, excuse me, state housing agencies, which issue social bonds, and the proceeds from these bonds are used to extend mortgages to low-income families, and also to finance the development of more affordable housing units. So increasing the supply of housing. You have to think about both supply and demand in this equation, and supply is certainly an important one to be thoughtful about and helping people access home ownership on the margins. So I'll leave it there. Sean, I don't know if you have any final words here.
Actually, yes. So we've received a few questions, and I have a few questions for you. But before we move on to Q&A, I do want to cover a couple of things about upcoming events, and that way people can have that in their back radar. So if you can, if you'll stop sharing your screen, and I'll share mine, so that I can direct people on how to register here. So this, and we've received some questions on this as far as how do I access your other content? So we really try to partner with advisors in 3 different ways. One of those is through education. So we provide webinars like this. We have a quarterly CIO call that talks about macro, on a macro level, what the economy is doing. Then we also have regular portfolio review calls where we go through each one of our funds and talk about what is going on in each one of those. So that's all in our education piece of how we partner with you. We also have a portfolio piece where we help you with constructing portfolio illustrations that you would be able to use with your clients. And we do this using both the risk tolerances that you give us, as well as values-based criteria for the different funds that we're using to construct those portfolios. And then in communication, we actually want to help you communicate with your clients more thoroughly. And so one of the primary ways that we do that is we do live webinars for you and your clients. So it's where you gather your clients together for an online event, and we speak at those. And I do that, as well as Jason Meyer, who's a partner here at Eventide. And the two of us both provide, we're both speakers for those events for you and your clients. So if you want to sign up for partnership with us in one of these different areas, you can go to go.eventideinvestments.com/partnership, and it will take you through how to get involved with us in those different levels. Or if you already have a relationship with one of our regional directors, reach out to them. Also, our next upcoming event, this one is actually qualifies for a CE credit. Discover Values-Based Investing with Eventide. It's actually a 4-hour event, so there's multiple speakers. We will cover a variety of topics, all on values-based investing. So we kind of dissect that landscape of what's going on in values-based investing. And these series of presentations, they tend to be inspirational, but very informative. So it's a great webinar series to attend. The next one is on June 17th. And again, it's from 1 to 5 Eastern time, and you can register for that at go.eventideinvestments.com/discover. So now We do have just a couple of minutes, and we've received a few questions through the Q&A. One of the first things I want to ask you, Faina, is what concerns do you have about housing? So it seems to be very hot right now, but what could cause it to cool? Because we have all of these macro factors that we're talking about with inflation or interest rates rising. Which of those are concerning to you, and how do you explain that in regards to this theme of home ownership?
Yeah, thanks, John. It's an important question. And I would say, I would take us back to, if you could take us back to the slide with the home ownership costs over time. I don't know if that's possible. Otherwise, I can just speak to it.
Yeah.
But
The let's see.
Yeah,
This,
sorry. The one further down that had the blue line through the middle.
that's right. Yep. Yep. There.
Yeah, there we go. Awesome, thanks. Right, so the concerns that I would have longer term are, around affordability. At what point would interest rates go up so much as to, to increase the homeownership cost to make them unsustainable? At what point would home prices rise so much that they would discourage, potential home buyers on the margins from participating in the market? And I expect that over time, as the economy continues to recover, and with time, the Fed has signaled that eventually they will raise rates. Mortgage rates will likely go up. But if you look at where they are now, really close to record lows, there's likely some more room to run for rates to rise before they start to really impact affordability. And so, it's a longer term concern, but given what we're seeing in terms of the structural supply demand equation playing out, with demand significantly exceeding supply and likely requiring years of new supply to meet that demand. For any folks on the margin who might drop out because of rising rates, there's still demand likely to exceed supply. And as supply starts to come on, it'll probably moderate the increase in house prices over time, softening that affordability concern. And we would expect and hope that incomes will continue to go up as well as the economy recovers and unemployment starts to go down. So there are a number of factors at play, and it's a question of timing and how fast and to what degree rates and prices might go up. But I would just bring us back to this bigger secular trend of this demand exceeding supply so significantly that we should, continue to see that for the foreseeable future.
So this next question, it concerns kind of the entire ecosystem again. In Eventide, we're primarily focused on ways to influence this and contribute to this trend, primarily through publicly traded companies like securitized companies that we can invest in. However, and I know this isn't what you covered, so I'm hoping you can speak to it some. Is there any role that nonprofits and even private companies are playing in this overall ecosystem of helping kind of break down some of these barriers for home buyers?
Yeah, that's a great question. I mean, it's a broad one, so I'll speak to it broadly.
Sure.
As far as I understand it, there are a number of nonprofits involved, even from an educational standpoint of helping potential home buyers, first of all, learn financial literacy, learn how to save and invest and prepare for home ownership, to be able to raise their FICO score, to be able to get that mortgage. There are nonprofits and even mortgage companies tied to some of the publicly traded home builders that have this educational component that I think is really helpful. And I would bring us back to the state housing agencies and other financial institutions that are helping to promote access to mortgages for folks that are able to meet a lower down payment requirement than others, and that maybe have lower FICO scores. So it's really a question of access there. And there could be an opportunity in the future. The majority of mortgages are securitized by the GSEs, the Fannie Mae's and Freddie Mac's. There could be an opportunity for more private securitization and sharing of risk of home buyers, which could change over time. So the ecosystem could continue to be more vibrant with respect to promoting access and risk sharing, so that folks on the margin can participate as well.
So we have one more question, and we've touched on this a little bit throughout the presentation, but I think it's worth asking again because it's what comes to my mind too. And actually, I've moved to this slide. I have this slide up on the screen because I anticipate that you might reference it. But what makes this time different than the financial crisis? So whenever I was talking about the people that got in trouble through whenever they ended up owing more on their houses than what their house was worth, and that was immediately following maybe an initiative to give mortgages to people that couldn't afford it. So what makes us see, I guess, can you speak to how maybe increasing access to home ownership does not have to come at the expense of irresponsibility? And what makes what we're doing now different than what was happening in the financial crisis?
Yeah, that's an excellent question. And, I would say that right now, just by nature of the supply demand dynamics, what you're seeing in this particular slide with lending standards tightening is that the folks with higher income, most likely, and higher FICO scores are just the ones who are able to win the bids on houses, and so that's reflected in this graph. There are several reasons this is different from the Great Financial Crisis. One of them, as we saw in one of the previous charts, is that there was a steady increasing oversupply buildup leading up to the financial crisis. And we were in this situation where we had more homes than we had demand for. And so we're definitely not seeing that today. The millennial generation was not coming into its peak home buying years. And there's, back to the lending standards, there is more scrutiny and more due diligence with banks and home builders having been burnt in the financial crisis, to be more cautious in their risk management practices. It was a wake-up call for rating agencies. And so I think the combination of those factors, and again, the structural supply demand dynamics that we're seeing, among other reasons, makes this a different situation. So we have a long runway to catch up to this demand. And granted, housing, it's a cyclical industry, but we're also seeing this secular trend likely to play out over the foreseeable future.
That's great. Thanks, Faina. Your insights are very helpful. I actually learned a lot just through preparing for this webinar with you. And I've been already spreading your knowledge to a lot of my friends. It's just a common conversation that a lot of people are having right now because it's noticeable. Home ownership trends are noticeable, and it's something that everybody can relate to. So thanks for joining us, Faina. It's very helpful. And thank everyone on this call for joining. I will again put up this link here to register for our next event. You can jot that down or go to that URL now. Go.eventideinvestments.com/discover for Discover Values-Based Investing on June 17th. I hope to see you then. You may now sign off the call. Thanks for joining.